Peace of Mind radio podcast, and we're in a little bit different location today, but we've got Eric Douglas and Tad Douglas here, and of course I'm Brian Ramsey, and this week we're talking about a follow-up to what we talked about last week, right? Actually, it's a day apart when we're recording them, but we're the shows are actually going to air a week apart. But last week we started off talking about just kind of what's happening in the market and a few common mistakes that we see investors make during, kind of turbulent market times. And really what we want to focus on today was sort of the steps that we think investors should do during turbulent times, right?
Well, we talked about the turbulent times. Now we need to talk about how to handle and how to make it through some of these turbulent times.
Yeah, what do you need to be doing now if you haven't already?
Yeah, so here's what I thought we'd do. We've got them kind of listed out here, but we're gonna take them sort of step 1 through 5. And what I thought we'd do is just kind of list them, and then let's go back and talk about each one of them in more detail. So the first is you have to understand during turbulent times, you have to understand what your income sources are, because income sources are changing. We've talked about that, and we're going to talk more about, or talked about last week. We're going to talk about it again this week. Number 2, you got to understand what your budget is, how much you're going to spend, what your monthly expenses are. And I would say that's probably the one space where most prospective clients that we see where they are a little short. They don't know what they spend, right? Number 3, you have to establish, the old Dave Ramsey emergency fund, but you got to have some cash to setting aside that's not in the market that you can get to it. So it's just incredibly important you have some sort of emergency fund. And then you need to evaluate your portfolio to make sure that it still reflects your current risk profile, that it reflects the holdings that you want during turbulent times. And we'll get more into that in just a few minutes. And then last, which is near and dear to my heart, as you guys know, I kind of harp on this quite a bit, and that is just making sure that your estate documents are up that reflect your current wishes. And that's one that often gets pushed to the back burner, or, hey, I did it 15 years ago, and I don't necessarily need to review it. But often what we find, and everybody's kind of shaking their head, is that when a prospective client comes in and they have estate documents, it doesn't always reflect what they currently feel.
A lot can change in 15 years, right?
Yeah. Oh, yeah, absolutely. So let's do this. Let's take the first one, and let's just kind of go around the room here. We'll talk about what we talk about when we get a prospective client that comes in and it's kind of this rocky market, or even an existing client for that matter. But what are some of the things that we talk about when it comes to income? How can incomes change during market cycles?
Well, right now, what we've seen with a certain number of people is they've lost income or seen it reduced because of the COVID-19 response. But typically when people come in, what we're looking at is evaluating what their income is from all sources, which could be salary or hourly wages in some cases, dividend interest income from other sources. Some of the people that we're talking to in their maybe early to mid-60s have already started taking some Social Security. But we're going to look at all of the sources of income to see, first of all, how reliable it is, obviously what the level of income is, and what the potential for changes are.
Yeah, 2 things that seem to be very timely today as we record this, and today is Thursday the 30th, April 30th as we're recording this, so unemployment numbers just came out today. We're over 18, we're about 18.5% unemployment as of today. So we had another 3.5 million jobless claims for the previous week, the week that ended last week, right? That number gets us to about 1 in 4 Americans of the working age population that has lost its job in the past 2 months, which is just an insane number when you think about that. A quarter of the population has lost their job or filed for unemployment in the last 6 weeks. Furthermore, another article I saw this morning, and I'm seeing a lot more of these articles, you're seeing a lot of companies talk about, you talked about dividends, a lot of Fortune 500 companies, for example, are looking to probably suspend dividends throughout the year. It's something that they're looking at because they've had to lay off a certain number of their workforce, right? And when
some already have.
Absolutely, and you need to prepare for it and try to continue to pass on as much value as you can to your shareholders. And unfortunately, in times like these, continuing to pay your shareholders when you're having to lay off a lot of employees, from a PR perspective, it's certainly not a good look. But just monetarily, it just makes pretty good fiscal sense.
Yeah, and I think one of the things that is pretty interesting is we talked about the unemployment number, and while the numbers are, like as you said, just staggering, I mean, it's unbelievable. But part of what we have to remember is that some of these layoffs or furloughs or whatever you want to call it are temporary, meaning clients are because businesses are shut down, right? I mean, especially retail. There's really no retail to really speak of. But if you're a small restaurant and you've laid your employees off, as a server, let's just use a server as an example. So a server is really commission based, right? So their income depends. Yeah, for the most part. And so if you're a furloughed server, then your income is temporarily disrupted, knowing that when your restaurant opens back up, you're going to come back and earn, some portion of what you were already earning. I use that as an example because it's important to understand when your income, when you're in a market like this, and let's say you get laid off or you get furloughed, it's important to know that that income may be a temporary type solution. So you got to have a plan in place in order to be able to get through that temporary period. Although we all know that of the 30 some million job unemployment claims?
We're over 30, yeah.
Yeah, over 30. And that's just the unemployment claims so far, right? There's probably more to come. But we know that there's some percentage, and I don't know what it is, only time will tell, but there's some percentage of those folks are going to permanently lose their job, right? So they're going to have to be seeking other employment. And unemployment benefits don't last forever. It's only for a finite period of time. So that's why you always hear, and you may not always hear it, but it's a general rule of thumb that you keep 3 to 6 months worth of living expenses out of the market or in a savings account or in your checking account or something. So as we get through this and we're talking about emergency funds and all that, we'll get into more detail. But I think that's important to know that you have to understand what your sources of income are, how they're going to be disrupted, if any at all. And then if they are disrupted, you got to have a plan in place to be able to cover that income for whatever period of time.
And that period of time could be whatever period of time is comfortable for you. For some, that may be 3 months. For others, it may be 9 to 12 months, right? So depending upon your risk tolerance and how comfortable you feel within your employment and of course, other factors as well. But, it's just of vital importance to know that when you go to bed at night, you can wake up knowing that there is a portion of money that you can live off of for the next 6 to 12 months, that no matter what happens in the stock market, you're going to be okay and you're going to have all of your needs and expenses taken care of.
Yeah, absolutely.
One group that I'd like to address is those people who are already retired and are taking withdrawals from their investment accounts, whether they're IRAs, 401ks, or regular investment accounts. Taking money out of those accounts at a time when the markets are depressed, even though the market is not down as much as it was a month ago, you want to make certain that that's sustainable. If you don't have adequate reserves in terms of savings, income, and so forth that's coming in outside of those accounts, you may need to temporarily reduce or cease taking money out of those accounts. In other words, if I have not adequately prepared for an economic downturn, and I don't have cash in the bank, savings accounts, whatever it may look like, and I'm depending upon my investments for my income, then you're going to further accelerate the decline in those investment accounts.
Yeah, for sure. And which kind of leads to the second point. I mean, when you're taking, whether it's you go from a full salary to a reduced salary, or you're on unemployment, or maybe you don't have any income, or you're having to take reduced distributions out of an account, it's important to know how much you actually need in a time like this, right? So if you go back, and we're getting into knowing what your budget is, I should have said that up front, sorry. So when you talk about that, when you go to, let's say 3 months ago, I would think that most people, we were basically at full employment. Things were great. Markets were great. I don't know that many people worried about how much discretionary income they were spending. I think people were just going out spending, right? So just as a quick side note, we went out to the Louisville Boat and RV Show, which was back over the winter. And the guys in there were telling us at a couple of booths, they said that typically when they bring a set of boats out there, like if they bring 10, they may sell 4 or 5 during the show itself. Then they'll wind up selling a few afterwards, whatever. He said they were selling pretty much everything they had there. And the reason why is because at the end of the year, that happened in January, but people were looking at their 401k statements and going, oh my gosh, I'm up, 20% for the year, right?
Well, and then the bonus monies start coming in, the annual bonuses, which typically get paid in Q1 of the following year, right?
Yep.
So 2019 was a record year, so a lot of these people were probably expecting pretty large bonuses.
Yeah. So when you think about in great times, we always don't necessarily follow a budget. And I believe when it comes to kind of difficult times or trying times, or you get in a situation where you've lost your job, it's more important that you develop a budget, stick to that budget, and not only do you stick to a budget, but you have to line item your budget in order to determine like what's necessary and what is more discretionary, right? And so we all have done that. I mean, we're all pretty good at budgeting. We've all walked clients through it. So you have to sort of experience it and do it yourself before you can walk a client through it. And so, yeah, I've got certain expenses I know are just my bread and butter, keeping food on the table, shelter, all that good stuff. And then I have my discretionary pool that I know as well. So it's just important that you separate your budget so that when you're in a difficult time, maybe you only look at what's necessary, and that's what you budget for.
Well, I was going to say, regardless of if you're 25 or 85, when you're building a financial plan, the first building block that has to be laid really is the budget. You have to know, when we talked about income, we have to know how much money is coming in. Well, the second part of that is we have to know how much money is going out, and we need to know specifically where it is going, right? Because we can't craft any type of a financial plan. We can't craft any type of savings or investment strategy without knowing the numbers that we have to work with and how much you truly have to be able to invest and or save on a weekly, monthly, annual basis, right?
Yeah, I would tell you that, Tad and you and I have talked about this a lot over the years when we talk about financial planning. I will tell you that what's interesting to me is the volume of new clients that we've been introduced to that really have no idea what their budget is. They don't really know what they spend. And so as we're going through this process, the financial planning process, it's very important to make sure that the input, which means the data that we're getting from the client, is accurate. Because it's the old saying, right? The quality of the input's the quality of the output. So if you're telling us you're spending $4,000 a month, we need to know that that's really what you're spending. And I will tell you that we often find that somebody will say, clients will say, hey, I'm spending $4,000 a month. And then when you go through the planning process, there's a line item in the plan that says this money's not been accounted for, which means it's not been saved, it's not been spent. And they're blown away at the difference. And I'm like, yeah, you're probably spending some of that. You just don't know it, but you're probably spending it. So that tells me you're not doing that good of a job at budgeting. But the more they get into it and the more they get in the planning process, they understand that how important it is, and they get better at it.
It's that Prime-nesia, like you order stuff from Amazon Prime, it shows up on your doorstep, and you don't remember buying it or where it came from. Right?
Yeah, that's exactly right.
Eric and I met with some people about maybe 5 or 6 weeks ago, and we were going through their budget, and they were estimating their annual expenses at about $75,000. Well, their income was twice that. And I knew immediately that number was not correct after we analyzed what they were putting into their 401ks, what they were paying into taxes, and a couple of other things. Their expenses were closer to $100,000 a year. Now they said, well, yeah, because when he gets a bonus, we typically will spend that on vacation. They didn't count that in the budget. And so an easy way, or maybe a simple way would be a better way to say it, to estimate how much you're spending on an annual basis is to take your annual income, And then after you do your taxes, look at how much did you pay in federal, state, and local taxes? How much did you put in 401k plans, IRAs, and other savings vehicles? The rest is what you spent.
Mm-hmm.
And you may think you spend $4,000 a month, but it turns out that it's $5,000 a month. One of the good things about what we're going through now with this shutdown is something good, but I think it's not a template for what future recessions might look like, is that our entertainment budgets are way down because we're not going out to the movies. We're not going out doing things.
Eating out?
Well, some people are eating in more, but our entertainment budgets are way down, and clothing budgets are down. People are not going out buying things at the stores. Home improvement expenses may be going up. Right. But generally speaking, our expenses are down going through this. That's not typical for most recessions or most bear markets. So if the next time this happens in 4, 5, or 10 years, we don't want to look back and say, well, the last time this happened, I didn't spend as much money.
It's funny because I saw an interview with an executive from Levi. He was talking about, no one's buying jeans right now because everyone's sitting at home in sweatpants.
Yeah. Yeah, that's pretty good. Here's one other thing I'd say about budgeting. It's one thing to ask someone to do QuickBooks or Quicken or something like that. I mean, that's not everybody's thing, right? I mean, it may be some of us, but not everybody's going to use that type of resource to really understand what their expenses are. But there are some basic apps. Everybody, for the most part, has a smartphone. I mean, my parents have a smartphone. I mean, we've got a client who's 92, and she has a little smartphone. It's cute when she comes in. But for the most part, everybody has a phone. I think, apps are being I think we're finding out that apps can be very useful and beneficial, and it's not always just game apps or whatever. I mean, it's budgeting tools, and there's a ton of them out there. They're super easy to use. I use one in particular that I just connect my bank accounts to, and but I don't spend a ton of time on it. I mean, literally spend maybe an hour a month, maybe, and I jump in there and just maybe correct a few things, that come in that are miscategorized. But for the most part, these systems are super smart, and they will categorize to where you don't have to go through and do much work to it. And as long as, you're getting a pretty good idea of, making sure stuff's categorized properly, these budgeting tools will give you an idea of what you're spending, right? And they're great tools. I would just encourage you that if you don't use one, go out and do your research. Just Google it and say, what are the best budgeting apps out there. But I will tell you, that's a great tool. A good habit to get into is, using an app and sitting out for an hour every month and learning what you spend. I mean, you'd be shocked to see how much you actually spend when you do that.
One thing that may be obvious but probably needs to be stated is most of us have expenses that we pay once every 3 months, every 6 months, or once a year. Could be car insurance, home insurance, property taxes, something like that. That needs to be included in your budget as opposed to just, expenses that come up out of nowhere. There are ways to adjust for that or plan for that. But I think that's what throws a lot of people off because they go on vacation, they spend $3,000 or $4,000 or $5,000. We met with somebody yesterday that talked about spending $15,000 on a vacation. I'd like to go with them.
Yeah, I want to go with them. Yeah, for sure.
But those type of expenses, they may be one time a year or twice a year. They need to be planned for and budgeted for.
Yeah, and actually I'm glad you brought that up because the software budgeting that I use, it actually will allow you it shows you sort of where you are every month. So you set like my dining out is almost, I don't know what it is, but let's say it's $400 for the month. I don't eat out near that much, but you get my point. It will show you the further you get in the month where you are according to that budget. And every month you can set up like my car insurance or the car taxes, whatever. It's all due in December because I have vanity tags. I'm not vanity. I have Murray State tags, but so my tags are all due in December. So my budget for December is higher by X amount of dollars. So it actually, the system knows they're due because I've put them in there that way. So it adjusts my budget in December, right? So I just know I got to save up, which is what we're going to lead into in just a minute, which is saving money for saving emergency funding. But again, back to the budgeting tool, there's all kinds of different ways to do it. Everybody's going to do it a little differently. But if you find the right tool to help you budget, you'll be much better off. All right, who wants to do the third one?
Well, if we're going to talk about an emergency fund, we touched upon this already a little bit, but, like I said, just having a pot of money, just sitting in cash, no risk, no exposure to the stock market. You're not really invested in anything. You're just sitting in cash, sitting in a savings account in the bank, something that's 100% fully liquid that you have access to at the drop of a dime at any time to cover any type of expenses that might pop up, whether it's a quote-unquote true emergency or, the car breaks down, you need to take it to the shop, right? That's kind of the easy analogy, but just somewhere where you can go get a quick $1,000, $2,000. We talked about, generally speaking, we want at least 3 to 6 months worth of income or worth of expenses, I should say, which is where having a budget comes into play.
Yep.
So we know what that number is. But, typically if we have at least 6 months worth of expenses in there, up to upwards of a year's worth of expenses, that's going to help your peace of mind immensely. That's going to help you sleep. That's going to help you feel much better about investing and staying focused on the rest of your financial plan and not having heart palpitations, right? When we have the stock market volatility that we've had so far this year in the last month and a half, because at the end of the day, you've got a pot of money that you can access that has not been touched, has zero risk, and is still there. It's still what it's worth a month ago, a year ago, and you can get it at any time.
Yeah, there's two things I'd like to add to that. One is we want an emergency fund where we can get money quickly so that we don't use credit cards that are charged. I don't know what they charge nowadays, but 15, 18, 20% interest. So we don't want to increase debt at a time where we've got an emergency. Secondly is when we talk about 3 to 6 months worth of living expenses, that's going to depend upon individual situations. I have a lot of single women who are clients. Some are divorced, some are widowed, some have never been married. But someone who is single, whether male or female, and they depend upon one income, they might want 6 months or even more of their expenses set aside in an emergency fund. A married couple with 2 incomes might not need as much set aside as a married couple with just 1 income. They might not need you might need more in savings if you have children, especially if you have children where you are paying for schooling, whether it's a Catholic school or a private school, or maybe special needs, medical expenses, those kinds of things. That would all factor into how you determine what you're comfortable with having in savings, and also adjusting for the dependability of your income.
Yeah, so that's we talked about this one in a lot of detail. But the other thing I would tell you, and this is sort of just a general rule of thumb that we like to share with clients, is when it comes to money that has a specific purpose of less than 2 years should not be invested, right? So it's whether I know we're talking about saving money in an emergency fund for emergencies, but I just want to throw that in there that if you have money that's allocated for a specific purpose and that specific purpose is needed within 2 years, it does not need to be in the market. No market volatility, no exposure. Yes, you might be able to put it in the market and gain a little bit more than what's sitting in a savings account. But you can also have times, just like we're experiencing right now, and you needed $50,000 for a car or $50,000 to put down a down payment for a home, and then all of a sudden the market's pulled back, and now you got $35,000 that you have available for that purpose. So again, that's just another general rule of thumb that I wanted to share.
Well, I think that becomes infinitely more important when you're at or near retirement age. Because when you're living on a fixed income and you're relying on Social Security or maybe a pension, whatever forms of fixed income that you're currently living off of, if you're living off of your investments in any way, shape, or form, and you got to, cover a gap in your spending with some type of income, usually from your investments, to your point, that becomes infinitely more important to not play any games with any money that you need access to in the next 2 years.
Yeah, for sure. Okay, so so now that we've got, so what we talked about is just identifying your income. So step number one, is there any adjustment that's going to be made? Is it, if there is an adjustment in your income, is it going to be a temporary thing, or is it a permanent thing? Or is it a long-term, I should say? And then number two, we talked about refining your budget, just making sure you fully understand what it is you're spending. And even to another level, when it comes to budgeting, just make sure that you understand what your core living expenses are versus that discretionary part, and what you might be able to kind of live without in a case of emergency like we're talking about. Number three, we talked about establishing some sort of emergency fund or just cash on hand. We know it's not invested in the market. You can get to it if you need to, kind of same day. So now let's get into things that we should be considering when it comes to market volatility. And one of those is, what do we need to be doing with our portfolios if we have a market like this? Now, I will give you a good example. So I just had a conference call this morning with a client, and it was a client meeting, but we're having to do it remote, which is interesting. But and actually, they're working out pretty well. I know you guys are doing some too, and clients are adjusting to them. They're actually working out pretty well. But anyway, what we were talking about was they had moved a new account to us, and we made some adjustments to it. We were walking them through the adjustments that we're making, and he had said, "Hey, what do I need to do with my 401k?" Which we don't manage because it's still at his existing employer. So we kind of walk through what all that looks like, and so it's just important that that not only the accounts that we're managing, but those that we're not managing, we have to make sure that it's all invested properly given their circumstance, right? So I know we're going to talk about the different circumstances and things we need to be considering, but I just want to kind of point that out, that yes, it's important that, while we're making changes, it's important that accounts, all the accounts that you have, they all reflect what it is that you want to be, what should be happening in your investment portfolios.
Going through the times like we've had are a really good opportunity for us to evaluate, are we really invested in a way that's consistent with my tolerance for risk, with how much volatility up or down. Most people say I'm very tolerant of risk when the market's going up, not so tolerant going down. And most people overestimate their ability to tolerate risk in a down market. I think I shared in last week about a client who called me 3 weeks into the month, that he looked at his statement at the end of March and was really worried, thought we needed to make some changes. The statement looks a lot different now than it did at the beginning of March. But this is a really good time to evaluate, am I taking more risk than I want to? Did that first statement shock me so much that I don't want to take that much risk in the future? But the second thing we can evaluate the individual holdings in an account. I've done that with some of my client accounts where there were certain investments that did not perform as well as their peer group did. And so once they came back a little bit, I've deleted them. I've sold those, and I'm using something else because they didn't perform as well as I was hoping in a down market. So it's a really good time to evaluate not just your investment mix, but the individual holdings. How well did they do compared to a peer group?
Yeah, especially if you've had specific holdings for a long period of time that maybe you've been thinking about getting rid of, but you are handcuffed, if you will, because of the tax liability of, having to take that long-term capital gain by selling that, especially if you're talking about individual stocks, for example. So I know we've had a couple clients where we just haven't really made any changes to a portion of their account because the tax liability is going to be so big it would deter from the gains that we would have elsewhere. Well, the one opportunity that we have out of all of this now is, when the market came down, we had a great opportunity to do some tax loss harvesting and realize, or go ahead and take on either gains or get the tax liability down to a level where it's a lot easier to stomach, maybe, and also kind of clear the weeds out a little bit, right? So some of these individual holdings, to your point, that maybe are not doing, or not up to snuff or not up to par with what they should be doing, we can replace them with something a little bit better, and we have done that. And we're able to participate a little bit more efficiently in the upside that we've had in the last month and a half, and of course maybe going forward as well. I think another point I want to make as well, we do a lot of low-cost ETFs, exchange-traded funds, in our portfolios. Our portfolios are built primarily with ETFs. ETFs are a relatively newer phenomenon. They've really exploded in the last, let's say, 5 to 8 years. What they haven't lived through, or what the majority of exchange-traded funds on the market today, what they have not lived through, is extreme volatility like we currently have. Most of the ETFs that we use, and really just on the market period, were not around in 08, 09. And so we're seeing in real time, or really for the first time, how a lot of these funds are acting, or should be acting, according to whatever their investment objectives are. We've actually been very pleasantly surprised with a lot of our holdings. A few of them not so much, and we've made some changes because of that. But it's another thing to be aware of.
Well, we just, if someone's watching, they don't know this, but we consult with our other 3 partners about investment portfolios, and we just kind of made some decisions on the ones we want to use going forward. In comparing some of the holdings I've had in the past with some of the holdings that we're using now, is I found that some of the ETFs have outperformed the mutual funds significantly over a short window, maybe 30 days. But those funds have bounced back. But the problem is they still took on a lot of risk. And that's an unusual circumstance we saw with the quick bounce back by the market. That normally doesn't happen in a down market. So I think I've been very skeptical about ETFs up until the last couple of years, but this market, and partly because I wasn't sure how they would behave in a really bad market. Well, I've been reassured that they've actually held up better than many of the mutual funds that I've used.
Yeah, and so here's one of the points I'll make about evaluating your investment portfolio in a kind of a volatile market is, and what I always tell people, yes, we are making adjustments. And we'll continue to make adjustments. That's one of our roles, is to make sure that your investment strategy reflects what the market's doing, right? So we're trying to, in a down market, we try to limit the volatility, or, be more defensive in our posture. And then when the market turns more positive, we try to do our best to capture as much of the upside as we possibly can. But at the end of the day, the most important thing you can do in your portfolios is stick to your plan. That's the most important thing you can do. So once you have a financial plan in place, if you do a good financial plan, you will evaluate your current situation over different market cycles. So you'll see in the great market cycles how things work, and you also see in terrible market cycles how things work. And so it's just important to not panic, to not make major adjustments, and let your professionals make adjustments in your portfolios that they should be making.
Yeah, I was going to say, you don't want to go out and make changes in your portfolio just because you feel like you have to make changes in your portfolio. Understand the reasoning, understand the why behind why you want to make any type of a change in your portfolio if you are obviously doing it yourself.
Well, I think that's a really good point, because the worst thing any of us can be doing is acting emotionally because we're fearful that the market's going to go down more, or in some cases because we've had a big drop and people call and say, hey, stocks are on sale. It's a good time to buy. Emotion is not a good indicator of when to buy or sell. If an investment strategy, if we're doing a good job developing a financial plan and an investment strategy is going to take into an account, and we implement it well, is going to take into account that we do have cycles in the market. We have down cycles. We've had, since the comeback from the Great Recession of 2008 and 9, we've had 3 separate times where the market dropped between 18 and 19%. But in each of those cases, the market came back fairly quickly within a few months. That is probably not going to be the case with this particular drop, because we were down 35%. But the point is, if somebody had sold out after the market dropped 18 or 19%, and then within a couple of months the market bounced back, they would have missed out on the rebound rally. That's a normal occurrence for the market to drop 15 to 20%. It tends to happen every 2, 3, 4 years. So we can avoid acting emotionally if we understand the normal cycles of the market.
Yeah, that's a good point. And I would say that so if we're looking at evaluating an investment portfolio and making sure that it reflects, our current risk tolerance, it reflects our current wishes, and it reflects our current investment strategy that we're trying to accomplish for that particular account. The other thing we need to make sure that is accurate and accurately reflects our current wishes is making sure we update our state documents. I would tell you this is the one point that is kind of near and dear to me because of my previous experiences. I've seen where estate documents are not kept up to somebody's wishes, and they pass away, and all of a sudden there's, I don't know, unrest, or nobody knows exactly what's going on. And I've also seen where someone passes away and their estate is set up properly, and while it's difficult to go through, it's a very smooth process, and money gets allocated to whom they want, when they want, how they want, and it works very efficiently. And so I would just encourage you to, anytime that there's market volatility, or if there's a life event, marriage, divorce, kid, whatever you want to call it, I would just encourage you to go out and just pull your estate documents out, read through them, make sure they reflect what it is, that you currently still want. And if they don't, reach out to a professional and have them updated. It's not that big of a deal to have your will updated, or, to get an amendment done to a trust, or to change your financial power of attorney. You can, literally you could do all this stuff online if you really wanted to, but of course we would recommend you seek the advice of a professional and have them professionally do it. But if you wanted to do it yourself, and there's a lot of do-it-yourselfers out there, there's lots of resources to help you, to help you get through it. But I would just tell you, it's incredibly important that you keep your state documents up to.
And I would add to that, keep a printed document around the house, and that would include will, living will, power of attorney, trust documents if you have a trust, so that if something happens to you, a spouse or a child, whatever, that somebody can go to that, and everybody knows where those documents are. But secondly, it helps to have a digital copy of that. An attorney that drafts things for you should have that, but we have the ability to store that for you online because our estate planning, our financial planning software has a vault, and we can store those things in your personal vault on our financial planning website. That has, I know of several cases where that has been helpful when somebody was out of the country and they needed to have surgery and didn't have a copy of the living will, but they were able to go online, download a copy of their living will to show the doctors in another country that, in this case, the guy broke his leg skiing, that his wife could make these decisions for him. So that's something that could be very helpful.
Yeah. So let's wrap up the show. And Eric, I want you to kind of mention very quickly, this is something that you brought up, I don't know, the last time we recorded this show, because I hadn't recorded twice. We had some technical difficulties the first time. But Eric, why don't you speak to the opportunity that we're having a lot of conversation with right now, because the way the market is and the account values, and this is a couple of weeks ago when the account values were pulled back, quite a bit. Now they're rebounded a little bit, but we all think that we're going to see a pullback in the market, coming up over the next several weeks again. So we have an opportunity to maybe do Roth conversions. You might want to speak to what that looks like.
Well, it's certainly a hot topic right now, because when you think about what a Roth conversion is, and there's a lot of press, right? There's always a lot of press about Roth IRAs, and they're fantastic vehicles for a number of different reasons. Basically, because you get double tax treatment, you get to contribute a certain amount of money. It grows tax deferred. You don't have to pay any taxes on any of the growth. When you go to actually take distributions in retirement, it's all tax-free, right? So even at that point, you don't have to, pay taxes on it. The idea being that essentially if tax rates were to increase later on down the line, and we know that in 2026, we are due for a tax increase when the Trump tax cuts sunset, and who knows with the amount of government spending and all the debt that we're taking on. I mean, there's really only one way the government makes money, and that's through taxes, right? So who knows what tax rates will be on down the line. So the idea is if, we have tax rates that are artificially and historically low right now, go ahead and take the tax hit by converting some or all, depending upon individual circumstances, maybe a portion of your IRA accounts or traditional IRA accounts, converting them into a Roth IRA. Go ahead, pay the taxes now, let it continue to grow tax deferred, and then in your distribution years and in your retirement years, as you start to take those withdrawals, if you need to take those withdrawals, it's 100% tax-free. The value of doing something like that right now, and even right now when the market's rebounded, it's nowhere near what it was at its highs when we were sitting at 29,000 in the market. We're currently right around 24,000. They're on sale, for lack of a better term. When you think about a Roth conversion, because the values are compressed in your traditional IRAs, if you were thinking about converting to a Roth, because the values are a little bit less than what they were, you don't have to pay as much taxes on anything that you do convert. So you can actually convert probably more into a Roth without having to pay quite as much in taxes. And of course, once the market starts to rebound, you can still enjoy the gain when the market rebounds and comes back. But once again, that gain is all tax deferred, right?
Yeah, and I will say that when it comes to Roth conversions, if you have any questions about it, you can give us a call. We actually have software that we can plug your information into, and it's about account values and taxes, and we got to estimate what your taxes are going to look like in the future. But we can run Roth conversion, I guess, analysis, yeah, and it'll tell you whether it makes sense for you to do it or not.
And we can get very, very specific.
Oh, absolutely.
On, you should move X amount this year, X amount next year, X amount over the next 4 or 5 years, right?
Yep.
And we can map that out, and we can do different scenarios, because sometimes when we think about what might be most beneficial over the long term, well, sometimes that can be a pretty tough pill to swallow tax-wise in any given year that you are, making a Roth conversion. So we can give you or line up a couple different scenarios and figure out which one is the easiest for you to swallow.
Well, one of the great things about the software we have is that we can show if we return to the 2017 tax rates in 2026, what your tax bracket would look like, what your the tax impact of IRA or 401k withdrawals would look like, but also extend that out in the future 10 or 15 years. And we've had a couple of illustrations we've run for clients that showed that at some point in their 70s, because we don't have to take RMDs now until age 72, but we had a couple of people where their annual taxes on their withdrawals were going to be greater than their projected expenses because they had so much money in their 401k and IRA plans. One other thing I would mention, and this may not apply to very many people that are listening, but if someone has experienced a loss of income this year, either because they've lost a job temporarily or because they've taken a reduction in income, because we know some executives have willingly given up 15 or 25% of their income. My wife's company requested she take a 10% reduction in income. So it may look better to take a Roth conversion now and pay the taxes on portion of your assets this year than it would have back in January.
Yeah, for sure. So let's just kind of wrap this show up. And first of all, guys, I appreciate you jumping in here. This is always kind of fun to do these. But if you're listening and you've got questions about what we talked about, and you've never put a financial plan together, call us. Give us a call. Come in and see us. We'll meet with anybody for an hour. We don't charge for that. But just come in and say, what's this all about? What benefits come of a financial plan? We can sort of walk you through all that. But if you like the content that we're putting out as well, make sure that you subscribe or share it. We'll every week we're going to have a new topic, so just make sure you check back the next couple of weeks. And
Hi, thanks for taking the time today to enjoy our content. If you're watching here on YouTube, please take a moment to like and subscribe to our page. That way, whenever we release any new content, you will certainly be the first to know. If anything we said today resonated with you, please don't hesitate to give us a call. You can find all of our contact information available on our website, FamilyWealthPlanningPartners.com. Also, please don't hesitate to share any content as well that you might find relevant for any friends, family members, coworkers, really anybody within your network that might need to hear anything that we have to talk about. Once again, thanks for taking the time to view some of our content today, and we do look forward to working with you in the future.
The information given herein is taken from sources that IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as Independent Financial Partners, IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal-related strategies mentioned in this publication, as IFP does not provide any tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. Securities offered through IFP Securities, member FINRA, SIPC. Investment advice offered through IFP Advisors, LLC, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated.